Welcome everyone to First Thursday. Happy New Year. Hope everyone has had a great New Year. And I'm excited. This is a very interesting topic, taxes. So I'm going to just jump right into it. Of course, my name is Douglas Lodmell. I'm the managing partner and co-founder of Lodmell. And we've been doing asset protection for over 20 years. That's all we do is asset protection. But as you can imagine, taxes are involved in everything, whether it's estate planning, asset protection, or even tax planning. And this webinar is sponsored by the Asset Protection Council. That is our network of affiliate attorneys who look to us to provide the back-end asset protection services to them and their clients. So tax considerations of asset protection planning. So we originally had this webinar scheduled for just talking about asset protection planning and the tax considerations. However, the tax bill has passed, so I decided to just throw in a very little bit of the summary of the new tax plan because it affects all of us. So it's pretty interesting. This is by no means a complete summary of the whole thing. I myself haven't had time to digest it. It's going to take a little while. But I think there's some interesting first points that we can all get something out of. So the three questions I want to ask is, how will this new law affect your clients? How will this new law affect your practice? And how will the new law affect asset protection? So first, it's going to affect your clients primarily as a change in the tax rates themselves. The rates have changed. So we are now looking at, a couple of points lower for all the brackets except the lowest one. So, that's interesting. This chart is good. You can get this on the internet almost anywhere. And I certainly recommend that you start talking to your clients about this at some level. So for your clients, certain pass-through entities, that's been the big talk. If everybody recalls, this is the thing that everybody's really interested in, is how is it going to affect businesses? Itemized deductions and personal exemptions are eliminated. Standard deduction pretty much doubles. It goes from like $6,700 to $12,000. So if you have a lot of kids, this might work against you. If you have no kids, this works for you. The corporate tax rate, this is the biggie. I mean, this is what this was really all about, 35 to 21%. It's obviously huge. It's a massive tax cut for corporations. There may be instances where clients would actually want to become a C Corp instead of a pass-through entity. That's going to all depend. And I'm sure you're going to get lots of questions about this from clients. Even as estate planners and asset protection planners, it never ceases to amaze me that we constantly are talking about tax planning. I happen to be a tax attorney in the sense that I have an LLM, so I do understand it, but I don't practice in the area. So, oftentimes what I end up doing is working with clients to just help them understand, the basics, and then get them to the right place. Get them to where they need to be from the standpoint of, getting to their tax advisor, their CPA, et cetera. And I encourage you to do the same. Understand the basics, because clients do want to come to their attorney and basically feel like they've gotten a good summary. And honestly, 95% of the time, it's enough. That's all they needed. They just needed to understand the basics. And if you can do that for them, if we can do that for them, it saves them another call. And again, it makes them feel like, we are their primary source of quality information. And at the end of the day, that's really important. A couple of other little things. Mortgage interest is capped. You can only deduct now on the first $750,000. The Obamacare penalty, if you didn't have insurance, is dropped. And then there's a lot of other little changes at the end of the day that's going to affect all of our clients. Okay, what about you? Well, this is a big one. The estate tax exemption has now doubled. So it was already, even at $5.5 million, it pretty much eliminated a big chunk of the people who would need to worry about any sophisticated estate planning. Now at $11 million per person, $22 million for a married couple. God, that really eliminates the estate planning needs for the vast majority of the people out there. They just don't have to worry about it. Now, of course, there's still state issues, and there might be an inheritance tax in certain states. There's still planning that needs to be done. but this does affect everybody. As an estate planner, particularly, it really makes people, what happens with clients is the word goes around that, oh, you don't have to worry about it, and they don't worry about it. That's what they do. They don't want to deal with this. What I would recommend is that it makes asset protection that much more of a hook, that much more important as a primary driver to get clients into your office. Because estate planning is really now just, gosh, how many families do we have out of 100 that have more than $22 million estate? It's less than 1 in 100. So if you want to have still a healthy, robust practice where you do estate planning, find another way to get them in the door. And I would suggest that asset protection really is a great way to do that, because ironically, estate planning and asset protection have kind of flipped. When I started doing this, the estate tax unified credit was $650,000, and everybody needed estate planning. Doing planning was pretty much all the way around, and very few people thought they needed asset protection. It was kind of perceived as $5 and $10 million clients and up. Now it's the other way around. You need to be a $10 or $20 million family to need estate planning, but a $2 million family needs asset protection more than ever. So this really has flipped, and getting on board early, getting your practice turned in the direction of asset protection is just, the sooner the better. If there's one thing I've learned is start it. Even if it's not perfect, even if you're just getting a page up, we have great resources, by the way, to give you really quality asset protection content for your website. So you really can look like a very experienced asset protection planner right out the gate. And of course, when you're working with us, you are a very experienced asset protection planner, because we're doing it with you. We're hand in hand. So this is really a huge change, and it's going to affect all the estate planners out there. All right, so let's talk about the asset protection tools. This is really quick. These are the 3 primary tools that we use: limited liability company, asset management limited partnership, similar to a family limited partnership, and then of course the bridge trust. So the LLCs, we know they're for risky assets. They're for segregating them, risk into separate LLCs. They have charging order protection, which is in some states very good. And LLC, from a tax perspective, does not have to file a tax return if it's a disregarded entity. If. So what does it take to be a disregarded entity if you're an LLC? It means you're a single member. So you have to have one member. Who can that member be? Anybody who's an authorized and qualified owner of an LLC. So could it be another LLC? Yes. Could it be a limited partnership? Yes. And that's typically what we see in our planning, is that we'll have the asset management limited partnership holding as the holding company with the family assets, and then we'll have many LLCs underneath them. And whenever possible, we do make them single member. Why? So we don't have to file another tax return. Clients like simplicity. They really do. They want to keep things simple. So the best way to keep things simple is to remove obligations, and a tax return is an obligation. So I like single member LLCs as long as the single member is not the client. That would be the exception. Client single member LLCs could have less protection. But an LP-owned LLC that itself is multi-member, and particularly if connected to the bridge trust, we don't have any worries that the single member LLC has a problem. All activities reported on the single member's return, it's the LP in our case, which does, of course, file a federal 1065. A single member LLC is disregarded, does not have employees, does not have to file an excise tax liability, does not need an EIN number. So in some cases, single member LLCs don't even get an EIN number. I like that too. One less EIN for clients to keep track of, for clients to CPAs to keep track of. And that really is the definition for most of the LLCs we do for clients that are holding assets, like real estate and other things. So very good. And if it's a multi-member LLC, then of course it has to get an EIN number. There are some. Our clients are involved in partnerships. They're involved in all sorts of various things that with other people, and those are multi-member. And then they'll get a K1, and that K1 will flow up to their limited partnership, and they'll show up on their personal return. Okay, asset management limited partnership, the AMLP. That's the family holding company. holds the safe assets, the cash, the stock, the bonds, holds the LLCs and the other companies, et cetera. And it has very good charging order protection in Arizona. I say enhanced just because it's very good. It's not particularly enhanced as in, and there's some kind of magic to it. It's just a state that has proven to really respect the charging order. And you can include the family and, of course, the asset protection trust, which is what we want. We can make it to where your assets are also private by making the general partner a Wyoming limited liability company if we want, if the client needs that. So from a tax perspective, it's a pass-through entity, so we're not creating an additional tax. It does file a 1065 federal information return. Then it issues the K-1 to the partners. That's typically going to be the husband and the wife, and if the kids are involved in that, the kids as well. If it's organized in Arizona, then it does not have to file an Arizona state filing return. We've got a letter from Arizona saying, hey, if you don't do any business here, we don't need a return from you. If you live in California, for example, you still will pay the $800 franchise tax to California. That doesn't matter what type of entity you're in or where it's located. If you're a California resident, they want that $800 from everybody. So that's California. And with the limited partnership, there's always more than one member because it's a partnership, and an EIN number is always required. Okay, the bridge trust. This, of course, is the real key to the plan. It allows us to move assets out of the country. It massively enhances the domestic structures we just talked about, the LP and the LLCs. Not limited to any particular kind of risk. Any risk it's good for. Can add privacy and clearly adds a massive degree of protection for your client's assets. What about the taxes? How is it treated? Well, it's treated as a domestic grantor trust for tax purposes. This is the best news that your clients could get. What that means is that they don't have to have another tax return. It's tax neutral. Income is taxed directly to the settlers of the trust, which is, in the case of a husband and wife, would be husband and wife. There's no separate tax return for it, and it doesn't have any IRS filing requirements as long as it's in its domestic form. In other words, as long as we haven't crossed the bridge. If we cross the bridge, it becomes a foreign grantor trust. So it's still tax neutral, it's just no longer going to be domestic, which means that then it does have foreign requirements. However, for the vast majority of our clients, it's not ever going to be foreign. It's about 98% of our trusts are not triggered, meaning they do not have to cross the bridge, which means that most of them never go into the higher reporting requirement realm. They also keep their benefit of the grantor being able to serve as the trustee, which obviously clients like a lot. And there's no need to open up offshore accounts. And I don't encourage clients to open up offshore accounts. That's not usually necessary. Clients aren't really particularly looking for it. Occasionally a client will call me and that's what they want. Well, that's fine. If that's what they want, there's no issue with it whatsoever. However, it's not something we recommend. I like to keep the client's assets where they're already at, where they're comfortable with their current investment advisors, with all of the same people involved. This plan is protection for an emergency. It's really not designed to change their life in a day-to-day operating way. We don't want their accountants to blow a gasket on not understanding or having all this extra filing requirements. We don't want their current financial advisors to be worried that they're losing their accounts, their CPAs, all of that. We really want our structure to be as easy as possible. And it was designed that way on purpose. I designed it so that it would have as few moving parts as possible and as little reporting and compliance obligations as possible, while still leaving the door open to being the most protective type of trust in the world, which is an offshore Cook Islands asset protection trust. And that's why it really is the best of both worlds, because we keep it simple unless we need to make it complicated. So in the domestic, it's tax neutral, income tax to the settlers, EIN not required, no separate tax return required, no foreign trust IRS filing requirements. That's the bridge trust. If it becomes foreign, or if we start with a foreign asset protection trust, which occasionally we do with certain clients, then you do need an EIN. You are going to file a 1041 trust tax return. You also are going to file forms 3520 and 3520A, which are the foreign trust reporting requirements. It's still treated as a grantor trust, meaning it's not a completed gift. The assets are still included in the settler's estate, which again, with a $22 million cap now, the vast majority of our clients are not really going to even have to worry about getting assets out of their estate. If a trust does own foreign accounts, you absolutely have to file the FinCEN FACTA FBAR disclosures. Those are really critical. Don't miss them. You really don't want to mess that up. There's penalties if you fail to file them, and you know that's what all of the stuff was about 10 years ago with the UBS and all these foreign accounts where people were just not filing any income. They weren't paying any taxes on any of the income they were earning. That's what these forms are. There's also now CRS, which is the foreign version of FACTA, and that's now implemented all over in all European banks, et cetera. So in some ways, it's even more rigorous than FACTA. But suffice it to say, you can confidently tell your clients that the days of James Bond banking or Jason Bourne banking, where you come in with a number memorized and get access to all this money, are over. No banks are doing that. Every bank needs to know who their clients are. That's just the world we're in. So if you still get clients calling and wanting secret stuff, tell them no, it doesn't exist. Certainly, if it exists, you don't want to be a part of it. Let's put it that way. Those returns, by the way, are informational to the IRS. There's no extra tax for having either a foreign trust or a foreign account. There's no extra tax. It's simply reporting, and that's important. So, in some cases, it's worth the extra reporting, particularly if you're protecting your assets from litigation that threatens them from, completely. Having a little extra reporting requirements is no big deal. But for the average client who's not under direct threat, it's kind of a big deal, and they don't want to do it, and they shouldn't have to. So regardless of whether trust is foreign or domestic, if the trust opens a foreign account, it's got to comply with the foreign FACTA, which includes the FBAR and the FinCEN 114 filing requirements. This deserved a separate slide because I just want to make sure that if you're ever talking with a client about foreign accounts, even if it's in their name or it's in a domestic trust like the bridge trust, they still have FACTA disclosures, always. Anytime you have an account out of this country, there's FACTA disclosures. Again, FACTA is not the end of the world, but people get confused on this, and advisors get confused. And of course, I hope it goes without saying for everybody on the call, any income they earn in that account is taxable. They have to pay taxes on it. I spoke to someone this morning who was under the misunderstanding that if they had money offshore, they didn't have to pay taxes on it until they brought it back. That is wrong. It's always been wrong. I'm expecting it to continue to be wrong for a long, long time to come. So just be clear with your clients that it doesn't matter where they put their money. If they make money, they pay taxes as long as they're a U.S. taxpayer. So that's it. If you haven't joined the Asset Protection Council, I really encourage you to do so. There's no cost to it. It's an association of attorneys, CPAs, financial planners, professionals that want access to extremely high quality information on asset protection and all of the other topics that we cover. It's an extremely valuable tool to help you with clients. Of course, if you're an attorney, I think it's even more valuable because as an attorney, you get to co-counsel, and we can do the work. We can do all the heavy lifting. We can train you and teach you on how to implement and use asset protection. We can share that fee so that we're working together with the client, and yet you're getting to deliver to the client all of our experience and all of our technology through your office. So if you're an attorney, and I see many, many attorneys on the phone that are already Asset Protection Council members and we've done a lot of work together, they can tell you this is just a really good system for helping you to understand and add asset protection as a viable and immediate way for you to begin practicing in this area inside of your practice. So there are some questions. I'm gonna read them, and if you have any, please write them into the chat box now, and I will answer them before the end of this call. I see a bunch of question marks, so let me see which questions I've got. Okay. One is the slideshow downloadable. It is not, but Brian, who's also on this call, will email it to everybody on the call. So if you'd like a copy of the slideshow, just email Brian at lodmel.com, BRYAN at lodmel.com. And so he'll send you a copy of it. Please explain what you mean that clients don't want to be single member of single member LLC. Who's a single member? Okay, great question. Earlier I said, you really don't want the client to be the single member of the single member LLC. You would rather have the asset management limited partnership. Here's why I said that. In some states, the client being the single member has been seen by the courts to be weaker. And the reason is that the courts have looked at that and said, well, it's just a single member, and the single member is the very person who the liability is against. And so there has been a move away from using individuals, our clients, as the single member of their LLC. That there's exceptions to that. If it's their operating business and they're a doctor or a professional and they need to be the ones that own the business, then it's totally okay to have them as the single member of the single member LLC. If it's a business where they've already assumed the risk and it's a high risk business, again, like being a doctor, it's okay for them to be the single member LLC. But if it's an office building, let's say, that has $500,000 of equity in it, and the client's collecting rents, that we wouldn't want the client to be the single member, because if the LLC is pierced by a court and they look through it, one of the rationale that courts have used in this country over the past 10 years is that, well, it's a single member and the client's a single member, and the client's the one that was negligent in not failing to keep the fire alarm up to code, and the building burned down and 3 people died. They have pierced that veil. The better choice is to have the asset management limited partnership as the single member. That way it's in the protected entity. And remember, the asset management limited partnership is also connected to the bridge trust, which means that the bridge trust is really owning the vast majority of that LLC, which holds the valuable asset. So that's a great question. I mean, that's important. If you have questions about it on any individual client or case, of course, call me and we'll walk through it. As you know, there's always exceptions to every rule. So, if we're not sure, let's talk and make sure we get it right. Okay. I don't see any other questions. That's it then. I hope everybody had a fantastic new year and a great holiday season. I know I did. It was great. I'm looking forward to a great 2018. I would really encourage everyone on the phone to call me, set up an appointment with myself or my office to discuss how we can increase your asset protection business. The change in the estate tax really is real. I really think asset protection can help bring new clients in the door. We know how to do it. We've been doing it for 20 years. We understand how to market it, how to communicate about it, and we have a vast library of resources that you can get access to as an Asset Protection Council member right away. So I encourage you to do so. Thank you again for your attention, and we will see you next month. Remember, it's your money. Act like it.